I'm going to tell you the tale of two retirees. Each retire with $1 million, $1 million saved. Same funds, they're doing the same 5% withdrawal rate, and a decade later, one still has plenty of money, the other is nearly out of money. Now, neither made a mistake with their savings. The difference here is timing, something planners call sequence of return risk. You might have heard of that. It's one of the biggest factors in how the first 5 years of retirement play out. By the way, I'm Joe Falbo, a certified financial planner. I help individuals and families create retirement strategies designed to help them work toward retiring comfortably and then remaining retired comfortably. Now, while you're working, a market drop absolutely works in your favor. All right. As long as you have a plan, a diversified portfolio, you can buy shares on sale. I tell people this all the time. It's the exact opposite of what human behavior thinks, but it's the way you should be thinking while you're working. Retirement flips that. Your paycheck stops and withdrawals begin. You start taking from your account. If the market falls 20% in year one of retirement, $1 million portfolio drops to $800,000. Now, you still need your $50,000 a year in income, so you sell shares at a loss to get it. Those shares are gone before any recovery happens. Withdrawals from a shrinking account actually can deplete savings a lot quicker and a lot faster than the 30-year average return suggests. So planners often call that first 10 years of retirement the fragile decade. 3 moves I'm going to give to you right now that may help protect against it. Number 1 is hold 1 to 3 years of essential expenses in cash. So when the market drops, you pay bills from that buffer instead of selling stocks at a low point, right? We call that the war chest, right? So you have 1 to 3 years of cash for when the market's down severely, you have something to actually pay your bills with. Number 2, you build flexible spending rules. So you skip that inflation adjustment upwards in a down year, or maybe you reduce the amount of money you're taking by 10% if the portfolio drops more than 10%. Use a bucket strategy. One bucket covers 1 through 3 in cash, right? Safe money, that war chest. Bucket 2 covers year 4 through anywhere from 4 to 10 or 4 to 7. And that's in bonds and safe investments. And bucket 3 is your long-term growth investments to help you overcome inflation over that time. And you're not going to touch that for 7 to 10 years or more. In down markets, you live off the bucket number 1. In up markets, you refill it from bucket number 3, from the gains in bucket number 3. Now, if you're within 5 to 10 years of retirement, a professional plan can make out a map for you that will help you understand what the right buffer size is, what your right war chest should be, guardrails for your situation. Schedule a 15-minute call to start that conversation. Cash buffer, flexible spending rules, be flexible with your spending, and a bucket strategy work together to help protect the retirement you've built. I hope this message helps you.